Welcome to the Encrypted Oracle. Listen closely, because what you're about to hear could completely change how you see this drop. Bitcoin hit $126,000, an all-time high nobody had ever seen. And today we're 30% below that. Most people see that and panic. They sell. They walk away. They swear they'll never touch crypto again. But the historical data tells a completely different story. In 2017, Bitcoin dropped 38% during a full-on bull market before climbing to $20,000. In 2021, it fell 53% from its April ATH and then hit new highs in November. A 30% drop, in the historical context of Bitcoin, is not the end. It could be the beginning of something much bigger. And today I'm going to prove it to you with real numbers. Let's put this in historical perspective, because numbers don't lie, even though panic does. During the 2020 to 2021 cycle, Bitcoin had at least 4 corrections greater than 25% while the overall price was still going up. Not 1, not 2, 4. And every single one of those drops came with headlines saying exactly what they're saying today: the cycle is over, Bitcoin is dead, the party's finished. The result? Anyone who sold during those corrections missed the biggest gains in the recent history of digital assets. The current drop from $126,000 to around $88,000 represents the kind of correction institutional traders call a healthy pullback, a normal pause within a larger upward trend. I'm not saying it can't go lower. I'm saying the historical data suggests this is completely normal inside a bit. This is where the Oracle separates itself from the noise, because we're going to talk about what actually moves the market, on-chain data. And there are 5 indicators right now telling a very specific story. First, the MVRV score, which measures whether Bitcoin is overvalued or undervalued relative to its realized value, is currently below the historical danger zone, suggesting we're not in euphoria. Second, the SOPR, which tracks whether investors are selling at a profit or a loss, currently shows that long-term holders are not capitulating en masse. Third, the number of active addresses remains high, indicating real market participation, not abandonment. Fourth, the net unrealized profit and loss, or NUPL, is in the belief zone, not euphoria, which historically means the cycle is only halfway done. Fifth and most important, Bitcoin reserves on exchanges are at historic lows, meaning people aren't sending their Bitcoin to sell. They're holding it. This is what I most want you to see, because it's a pattern that repeats every single cycle, and most retail investors completely ignore it. While Bitcoin's price falls and the news screams disaster, on-chain data shows something radically different. Wallets holding more than 1,000 Bitcoin, what we call whales, have steadily increased their accumulation during recent weeks of correction. Glassnode data shows entities holding more than 10,000 BTC have been growing their positions on every significant red candle. Why would they do that if the cycle were over? They wouldn't. Whales aren't perfect, but they have access to information, analysis, and capital that the average investor simply doesn't. And their current behavior says, buy. On top of that, spot Bitcoin ETFs in the United States have continued to post net positive inflows even during this correction, signaling that institutional money hasn't left the asset. Stop. Just for a moment. I need to ask you something uncomfortable, because the Oracle doesn't exist just to tell you what you want to hear. What if you're completely wrong about how you're reading this market? I don't mean you specifically. I mean all of us. Because the market has a brutal ability to destroy consensus. In 2022, when the consensus was that Bitcoin would hit $200,000, it collapsed to $15,500. The real bearish scenario does exist. If Bitcoin breaks below $75,000 in a sustained way, with high volume and no quick recovery, then we genuinely need to reconsider the cycle's structure. Watch for these real warning signs. If the MVRV score enters negative territory, signaling true capitulation; if exchange reserves start rising sharply because holders are selling; if ETFs post sustained net outflows for more than 3 consecutive weeks. Those would be the actual red flags. Right now, none of them have triggered. But you need to know them so you're not trading blind. I want you to see this comparison, because historical numbers are the only reliable compass in a market dominated by emotions. The 2013 cycle, Bitcoin went from $13 to $1,150, a gain of 8,700%. During that cycle there were corrections of up to 45%. The 2017 cycle, Bitcoin went from $1,000 to $20,000, a gain of 1,900%. During that cycle there were corrections of up to 38%. The 2020-2021 cycle, Bitcoin went from $10,000 to $69,000, a gain of 590%. The biggest correction in that cycle was 53%. Now we're in the 2024-2025 cycle. Bitcoin went from around $25,000 to $126,000, a gain of 404%. And the current correction is 30%. If we follow the historical pattern, this correction is within the normal range and the cycle may not be over. In fact, the 2024-2025 cycle would be the first in Bitcoin's history to go without at least one 30% correction during its run, which statistically would make it the mildest of all. And that's before we factor in that institutional adoption is at an all-time high. This is the question everyone is asking, and the honest answer is, nobody knows with absolute certainty. That includes the Oracle. But we can use evidence to calculate probabilities, and that's exactly what we're going to do. Bitcoin cycles historically last between 18 and 36 months from the halving to the final peak. The 2024 halving happened in April. If the cycle lasts the historical average of 24 months from the halving, the theoretical peak would be around April 2026. That means, according to the historical model, we could still have months of bull market ahead. On top of that, the stock-to-flow model, though criticized, has served as a general reference for years and projects prices higher than current levels for the period we're in. And the Pi cycle top indicator, which has accurately marked the tops of the last 3 cycles, has not yet given a top signal. Probability that the cycle ended at $126,000, possible, but historically unlikely since no top indicator has fired. Probability of further upside before the final peak, high, according to historical models. Enough analysis. Let's talk action, because knowledge without action is just expensive entertainment. Here is the concrete plan the Oracle recommends for this scenario. Step 1. Don't sell your long-term positions out of panic. If you bought Bitcoin more than 6 months ago with cycle conviction, a 30% correction is exactly what you should have expected and held through. Step 2. If you have available liquidity you can afford to leave untouched for at least 18 months, consider a DCA, dollar cost averaging, strategy, buying fractions of Bitcoin at support zones like $85,000 and $78,000 if it gets there. Step 3. Define your personal invalidation point. At what price would you admit the cycle is over and exit? Define that before the price gets there, not in the middle of the panic. Step 4. Monitor the 5 on-chain indicators we mentioned. If they start deteriorating simultaneously, adjust your strategy. Not reactively. Proactively. The person with a plan before the storm survives. The one who improvises during the storm gets wrecked. Here comes the final pattern interrupt, and it's the piece of data most finance channels don't have the courage to tell you, because it's not popular. The biggest risk right now is not that Bitcoin drops further. The biggest risk is that Bitcoin goes up without you because you were afraid. Data shows that most retail investors sell at exactly the worst moments in the cycle, during the deepest corrections, and then buy back at exactly the worst moments, near the tops, driven by FOMO. During the 2020-2021 cycle, the May 2021 correction took Bitcoin from $60,000 down to $30,000. Thousands of investors sold, convinced the cycle was over. 3 months later, Bitcoin hit $69,000, and those same people bought back in, this time at higher prices and right before the real collapse. The average investor's emotional cycle is, buy in euphoria, sell in fear, repeat. The Oracle proposes the opposite cycle, understand the data, act with logic, not adrenaline. That's what separates the investor who builds wealth from the one who simply transfers their wealth to others. Alright, we've reached the moment you've been waiting for, the Oracle's conclusion. And here it is. No, the Bitcoin cycle has probably not ended. On-chain indicators show no signs of a cycle top. Whales are accumulating. ETFs continue to post net positive inflows. The historical post-halving cycle model suggests there's still time left. The 30% correction from $126,000 is painful if you're living it with open positions, but it is historically normal and has been followed by significant rebounds in previous cycles. That said, the market can always surprise you. That's why the action plan and the invalidation levels we discussed aren't optional, they're mandatory if you want to survive and thrive in this space. What's my projection? I'm not going to give you a magic number, because that would be irresponsible. What I will tell you is this: the next 3 to 6 months will be defining for the cycle's structure, and those who are informed, positioned, and free from panic will be in the best place to take advantage of what's coming. Subscribe to This is crucial, and very few people talk about it openly. When Bitcoin drops 30%, your brain activates survival mode. The fear of losing is 2.5 times more powerful than the joy of gaining, according to behavioral economics research by Kahneman and Tversky. So you start seeking out negative news, you ignore positive data, and your confirmation bias builds a catastrophic narrative for you. The result: you sell exactly when you should be buying. In 2020, when Bitcoin crashed to $3,800 in March, millions sold. 6 months later it was trading at $12,000. Your worst enemy in crypto is not the market. It's yourself. Understanding this isn't cheap motivation, it's a real competitive advantage. This video is possible thanks to Binance. Compare Bitcoin sin commissions. Link in description. Here's a distinction professional traders know and retail investors almost always ignore. There is Bitcoin's technical price, what the chart shows, and there is the emotional price, what you believe it's worth based on how you feel today. When BTC was at $126,000 and everyone was optimistic, the emotional price was maybe $200,000. Today, with the 30% drop, many people's emotional price is $50,000 or even lower. But the fundamentals haven't changed. Institutional adoption keeps growing. BlackRock, Fidelity, and dozens of sovereign wealth funds are still accumulating. MicroStrategy, led by that bald CEO everyone knows, bought more Bitcoin this week. The emotional price and the real price are diverging, and that divergence is exactly where fortunes are built. Let's do a quick exercise. I'm going to read you real headlines from international media and I want you to guess the year. Headline 1, Bitcoin is dead, the bubble has burst forever. That was 2018, when it fell from $20,000 to $3,000. Headline 2, the crypto experiment failed, regulators will destroy Bitcoin. That was 2022, when FTX collapsed and BTC dropped to $15,000, that curly-haired, nervous-faced guy destroyed market confidence. Headline 3, Bitcoin has no real value, it's pure speculation. That was 2020, during the COVID crash. In every single one of those moments, the following cycle carried Bitcoin to new all-time highs. The pattern is so consistent it has a name among analysts, the despair cycle. And right now, you are inside one. Let's talk about the most powerful and most ignored force in the Bitcoin ecosystem, the halving. Approximately every 4 years, the reward miners receive gets cut in half. This automatically and predictably reduces the new supply of Bitcoin entering the market. The last halving was in April 2024. Historically, the peak of the bull cycle occurs between 12 and 18 months after the halving. If we do the math, we are sitting exactly inside that window right now. The 2012 halving took Bitcoin from $12 to $1,100. The 2016 halving took it from $650 to nearly $20,000. The 2020 halving took it from $8,700 to $69,000. The math of the halving isn't magic, it's programmed scarcity. And scarcity, when combined with growing demand, has only one possible outcome. This is what differentiates this cycle from every previous one, and it's the strongest argument against this cycle is over thesis. In 2017, Bitcoin was mostly retail, individual people buying from home. In 2021, a few institutions dipped their toes in cautiously. But in 2024 and 2025, something unprecedented happened. Spot Bitcoin ETFs approved by the SEC in the United States attracted more than $50 billion in assets under management in less than a year. That is the fastest capital inflow in the history of any financial asset class. BlackRock, the world's largest fund with nearly $10 trillion in assets, now recommends Bitcoin to its clients. When institutional money enters, it doesn't exit in panic over a 30% correction. That is simply not how large funds operate. There is a cognitive bias that destroys more fortunes than any bad investment, the omission bias. It's the tendency to treat doing nothing as the safe option. But doing nothing also carries an enormous cost. If Bitcoin right now is in a correction within an ongoing bull cycle and you don't act, the opportunity cost can be catastrophic. Think about it this way: in July 2021, Bitcoin fell from $64,000 to $29,000, exactly 54%. Everyone who said "I'll wait for it to drop more" never saw that price again. 16 months later it was at $69,000. Analysis paralysis is an investment strategy, but it's the worst possible one in asymmetric markets like Bitcoin, where the upside can be 5 to 10 times your investment while the downside is limited if you manage risk properly. Let's be completely transparent and walk through the 3 possible scenarios without any emotional filters. Optimistic scenario: the cycle continues, Bitcoin finds support between $80,000 and $90,000, bounces strongly, and reaches new all-time highs between $150,000 and $200,000 over the next 6 to 12 months. Estimated probability from analysts like Plan B and Willy Woo, 60 to 70%. Neutral scenario: extended correction, Bitcoin consolidates between $75,000 and $95,000 for several months, eventually resumes the uptrend but at a slower pace. Probability, 20 to 25%. Bearish scenario: the cycle ended prematurely due to some external shock, aggressive regulation, or severe macroeconomic crisis, and Bitcoin drops to the $50,000 to $60,000 range. Probability according to market consensus, less than 15%. The numbers tell you which side of the bet makes more mathematical sense. Okay, we've reached the most practical moment of the entire video. I'm going to give you the exact strategy sophisticated investors use in moments like this, no fluff. First, never put everything in at one price. If you have capital available to invest, split it into 3 or 4 equal parts. Buy the first part right now at the current level. Keep the second part ready for if Bitcoin drops an additional 10%. Third part for if it drops another 20% from there. This is called strategic DCA and it eliminates the risk of buying at exactly the worst moment. Second, define your time horizon before you invest. If you can't handle seeing your capital in the red for 6 months, reduce the size of your position. Third, set an emotional stop loss, a price at which you will ask yourself whether the fundamentals have changed, not just the price. Discipline beats talent in financial markets every single time. After analyzing the on-chain indicators, historical cycles, whale behavior, market psychology, macroeconomic fundamentals, and the 3 possible scenarios, we arrive at the conclusion the data supports. No, the Bitcoin cycle has probably not ended. A 30% correction from the ATH is completely normal, historically predictable, and has occurred in every single bull cycle without exception. On-chain indicators show no signs of mass distribution. Institutional money remains committed. The halving effect is still unfolding. And the macro context, with rates falling and global liquidity increasing, favors risk assets. But always remember, this is not financial advice. It is analysis based on historical data. Your personal situation, your risk tolerance, and your time horizon are unique. If you made it this far, you are exactly the type of person who takes their finances seriously, and that deserves recognition. Most people abandoned the video within 2 minutes. You stayed, you analyzed, and now you have a perspective that 95% of retail investors simply don't have. But this is just the beginning. In the coming days I'm going to publish the detailed technical analysis with the exact support and resistance levels you need to watch. Also a video on how to manage risk in altcoins during Bitcoin corrections, and an exclusive interview with an institutional fund manager about their outlook for the rest of the year. To make sure you don't miss a single thing, subscribe now, hit the notification bell, and drop one thing in the comments. Right now, are you team buy, team wait, or team I already sold everything? I want to read your answer. Subscribe to the channel and ring the bell to never miss a video. Every week we publish information that can change your financial future.